During the past few videos, we talked a lot about private equity, venture capital, and hedge funds, although they are all awesome investment vehicles for wealthy people and professional investors. For most of us, they are out of the reach. Usually, if you would like to invest there, the tickets are at least $500,000 or even $1 million. Is there something else available for people willing to invest few bucks here and there? Mutual funds are designed with that in mind, to pool the money from wide population and invest such a pooled capital in securities, helping them all to reduce risk exposure through diversification by offering them professional management services, expertise, accessibility, and convenience. On top of those funds, established by the largest investment banks and their asset management divisions, Vanguard, Fidelity, Charles Schwab, and similar are some of the most popular names in the industry with trillions of dollars under management. So, what is a mutual fund? A mutual fund is an investment vehicle that pools money from multiple investors to purchase a diversified portfolio of securities such as stocks, bonds, and other assets. The core idea here is that instead of investing your money on your own in just a few stocks based on your limited experience and investment capacity, a mutual fund will invest your money in dozens of stocks or bonds on your behalf by pooling your money with money coming from your peers and carefully designing investment strategies by experienced financial market experts. Keep in mind that mutual funds come in various forms, each with its own investment strategy and objectives. The primary types of mutual funds include equity funds. These funds invest primarily in stocks listed at stock exchanges, and they are generally considered higher risk but offer the potential for higher returns. Although there are general equity funds, most of them are specialized for different sectors or indices, as we will explain soon. Bond funds, or fixed income funds. Bond funds invest in fixed-income securities like government bonds, corporate bonds, and other debt instruments. These funds are generally considered lower risk than equity funds and provide regular income through interest payments. Money market funds. These funds invest in short-term, high-quality debt securities like treasury bills and commercial papers. They are among the safest investments, offering low returns but high liquidity. Balanced funds, or hybrid funds. Balanced funds invest in a mix of equities and fixed-income securities, aiming to balance the potential for growth with income generation and risk reduction. These funds are suitable for investors seeking a moderate level of risk. Index funds. Index funds aim to replicate the performance of a specific market index, such as the S&P 500. They offer broad market exposure, low operating expenses, and passive management, making them popular among investors seeking a cost-effective way to invest in the market. Sector funds. Sector funds focus on specific sectors of the economy, such as technology, healthcare, or energy. These funds allow investors to target particular industries, but come with higher risk due to their concentrated exposure. International and global funds. These funds invest in companies located outside the investor's home country or even globally. They provide exposure to international markets but come with risks related to currency fluctuations and geopolitical factors. So, you might be wondering how mutual funds operate. They are managed by investment companies, which employ professional fund managers and analysts to oversee the fund's portfolio. The operation of a mutual fund involves several key steps. Creation and offering. A mutual fund is created by an investment company, which establishes the fund's objectives, strategies, and fees. The fund is then offered to the public through various channels, such as brokerage firms, financial advisors, and directly from the fund company. Pooling of investor money. When investors purchase shares in a mutual fund, their money is pooled together to buy a diversified portfolio of securities. Each investor owns shares of the fund, representing a proportional interest in the underlying assets. Investment management. The fund manager is responsible for making investment decisions based on the fund's objectives and strategy. This includes selecting securities to buy or sell, determining asset allocation, and managing risks. Daily NAV calculation. At the end of each trading day, the fund's net asset value, or NAV, is calculated by dividing the total value of the fund's assets minus its liabilities by the number of outstanding shares. This NAV is the price at which investors can buy or sell shares in the fund. Distribution of income and capital gains. Mutual funds generate income through dividends, interest payments, and capital gains from the sale of securities. This income is distributed to investors periodically, usually on a quarterly or annual basis. Close-ended versus open-ended funds. Many mutual funds are open-ended, meaning you can invest whenever you want, and new shares will be issued for you at a NAV value. And you can also ask for your money anytime. And the fund managers will sell the securities in the value you own, meaning the NAV at a stated day, and pay you out for your stake. Close-ended funds have limited number of shares, and you can buy them on the market and sell them to other investors whenever you want, based on the market liquidity, not directly to the fund. Regarding the compensation, fund managers earn significantly less compared to those running PE, VC, or hedge funds measured by percentages, although their earning might be even bigger since they can pool significant capital. Here, there are few items you have to pay your attention to. Management fees. These are the primary source of compensation for the investment company managing the mutual fund. The fee is charged as a percentage of the fund's assets under management and usually ranges between 0.1 to 2.5% depending on the investment strategy. If the strategy is passive, like index funds, the fee will be low since it does not require extensive research work, constant trading expenses, and expertise. Front-end loads. This is a fee charged at the time of purchase. It is a percentage of the initial investment and is typically used to compensate the financial advisors or brokers who sell the fund. Front-end loads usually range from 3 to 5% of the investment amount. Back-end loads. This fee is charged when investors sell their shares within a certain period, usually declining over time. For example, a back-end load may start at 5% if sold within the first year and decrease by 1% each year until it disappears after 5 to 7 years. Other fees. Some other fees might be applied as well, based on the specific fund policy. Finally, we can say that mutual funds are a versatile and accessible investment vehicles, offering a range of benefits such as diversification, professional management, and liquidity. With various types of mutual funds available, investors can choose funds that match their risk tolerance, investment objectives, and financial goals.